Imagine if you could invest in the stock market without ever stressing about whether prices are too high or too low. Sounds impossible, right? But there's a proven way to do just that, and it's called dollar cost averaging, or DCA for short. This strategy is trusted by some of the world's most successful long-term investors. In this video, we'll break down exactly how DCA works, why it's so effective, and how you can start using it today, even if you're a complete beginner. Let's dive in and discover how you can make investing stress-free. Dollar cost averaging means investing a fixed amount of money at regular intervals, no matter what the market is doing. For example, you might invest $200 every single month into an index fund, regardless of whether the market is up or down. This approach helps you buy more shares when prices are low and fewer when prices are high automatically. It's a simple, hands-off way to build wealth over time without having to guess the perfect moment to invest. Let's look at a practical example. Suppose you invest $200 every month, rain or shine. Some months the market is up and your money buys fewer shares. Other months prices are down and you get more shares for the same amount. Over time, this strategy averages out your purchase price, helping you avoid the risk of investing a lump sum at the wrong time. It's a powerful way to build your portfolio steadily and reduce stress. How does dollar cost averaging work so well? It's all about the math. When prices drop, your fixed investment buys more shares. When prices rise, you buy fewer. Over time, your average cost per share is often lower than if you had invested all your money at once, especially if you happen to invest right before a market drop. This mathematical advantage helps smooth out the ups and downs of the market, making your investment journey less stressful. One of the biggest challenges for investors is trying to predict when the market will go up or down. Even professional investors struggle with market timing. Dollar cost averaging takes this pressure off your shoulders. By investing regularly, you don't have to worry about catching the market at its lowest or highest point. Instead, you let time and consistency do the heavy lifting for you. You might wonder how dollar cost averaging compares to investing a lump sum all at once. Historically, lump sum investing can outperform DCA if you invest at the perfect time. But let's be honest, most of us can't predict the market's next move. DCA shines in declining or volatile markets, protecting you from buying at the peak and spreading your risk over time. For most people, especially those investing from their paycheck, DCA is the smarter, safer choice. For everyday investors, dollar cost averaging fits perfectly with how we earn and save money. Most people receive a paycheck every month, so investing a set amount regularly is natural and easy to stick with. There's no need to save up a huge lump sum or worry about market timing. DCA makes investing accessible and manageable for everyone, especially beginners. Let's walk through a real-world example. Imagine you invest $200 every month for a year into a fund whose price goes up and down. In months when the price is lower, your $200 buys more units. When the price is higher, you get fewer units. At the end of the year, your average cost per unit is actually lower than the average price over those 12 months. That's the magic of dollar cost averaging in action. The real advantage of dollar cost averaging is that it helps you avoid the emotional roller coaster of the market. Instead of worrying about whether now is the right time to invest, you stick to your plan and let the numbers work in your favor. Over time, this steady approach can help you build wealth with less stress and fewer regrets. Getting started with dollar cost averaging is simpler than you might think. Most investment platforms like Fidelity, Vanguard, or Schwab let you set up automatic monthly investments in just a few minutes. Choose your fund, pick the amount, and select the date. Payday is a great choice. Once it's set up, your investments happen automatically and you don't have to lift a finger. After you've set up your automatic investments, the best thing you can do is nothing. Check your account once a month at most, but resist the urge to tinker or time the market. The real power of DCA comes from letting time and consistency work for you. Over months and years, your investments can grow steadily, and you'll thank yourself for sticking with the plan. While dollar cost averaging is simple, there are a few mistakes to watch out for. Don't skip months or try to time the market. Consistency is key. Also, avoid checking your account too often, as short-term market moves can be distracting. Stick to your schedule, trust the process, and remember that DCA is a long-term strategy. Dollar cost averaging is especially powerful when used with index funds. These funds track the overall market and are known for their low fees and broad diversification. By investing in an index fund regularly, you're building a solid foundation for long-term growth without having to pick individual stocks or worry about market swings. One of the biggest benefits of dollar cost averaging is peace of mind. You don't have to stress about market news or sudden drops. By sticking to your plan, you avoid the emotional ups and downs that cause many investors to make costly mistakes. DCA lets you focus on your long-term goals, not daily headlines. Dollar cost averaging is a great fit for beginners, busy professionals, or anyone who wants a simple, effective way to invest. If you have a regular income and want to build wealth over time without constant worry, DCA could be your best friend. It's a strategy that works for almost everyone, regardless of experience. Over the long term, dollar cost averaging can help you build significant wealth. By investing consistently, you take advantage of market growth and compounding returns. Even small amounts add up over time. The key is to start early, stay consistent, and let your investments grow year after year. Market ups and downs are a normal part of investing. With dollar cost averaging, volatility works in your favor. When prices drop, your regular investment buys more shares, lowering your average cost. When markets recover, you benefit from owning more shares bought at lower prices. DCA helps you stay calm and keep investing no matter what the headlines say. Ready to get started? Choose a reputable investment platform like Fidelity, Vanguard, or Schwab. Set up an automatic monthly investment into a diversified fund, pick your amount, and let the system do the rest. The sooner you start, the more time your money has to grow. Remember, the best time to start investing is always today. While DCA is mostly hands-off, it's a good idea to review your investments once a year. Check if your goals or income have changed and adjust your monthly amount if needed. Otherwise, stick to your plan and let time do its work. Consistency and patience are your greatest allies. If you're new to investing, dollar cost averaging is one of the easiest and most effective strategies to start with. It removes the guesswork, reduces stress, and helps you build wealth steadily. Whether you're saving for retirement, a house, or just your future, DCA can help you reach your goals. To sum up, dollar cost averaging is a simple, stress-free way to invest for the long term. By investing a fixed amount regularly, you avoid market timing, reduce risk, and build wealth over time. Set up your automatic investments, stay consistent, and let your money work for you. Thanks for watching, and see you in the next video.